What's up, guys? So a lot of us have been having a pretty big downturn on our portfolios. A lot of our strategies have been underperforming since around August. And I wanted to set out to make a strategy that is actually performing well during this market strategy. So I've been doing a lot of research over the past week or so. We've had a lot of chop in the market as over the past 3 months. Each one of these lines is a month, so this is about 3 months back. And just a lot of our strategies have not been performing well. But there have been a few that I've isolated and kind of figured out what's going on and why they are profitable. And it seems to be oil, Forex, like the ETF UUP, and a few other kind of odd rotators. But today I set out to make a strategy that uses UUP as its baseline. Now, if you're not familiar with UUP, it is the index bullish fund for the US dollar. It's essentially a Forex fund, and it's kind of it's usually an inverse of the S&P 500. But if you see here, it has been performing exceptionally well lately, and I think USO as well has been performing pretty well. So I set out to build a strategy around this, and this is what I came up with. And it can be back tested to 2007. It overperforms the housing market crash. It kind of just stays in line with the S&P 500 through this period. It kind of underperforms through 2018 on the sideways market, so there's some room for improvement there with interest rates rising and the sideways movement. It does pretty well through COVID. And as you can see, it does really well through this current bear market and chop, with a 23% drawdown, a 54 calmer, and a 13 alpha with a 12% annualized return. So let me walk you through how this strategy works. I actually built it backwards, so I actually started with just this sort function. So what we're going to do first is look at just this sort function. This is the isolated, and I've got lower standard deviation of returns here with a higher standard deviation of returns. If you don't know what standard deviation is, the simplest way to explain it is imagine just a throttle on a race car or an airplane. Highest standard deviation is essentially what has the maximum throttle, like what is the highest velocity, the highest magnitude, which ticker or strategy is moving really outside of its normal means. It's like redlining and hitting the top end. Lowest standard deviation is what is the lowest volatility, what is like basically not moving at all, what is the most defensive stable thing that I can put my money into. So let's start with lower standard deviation. I've got a 75-day SDR bottom two, and we're rotating between UUP, DBC, USO, and GLD. If you want to reduce your K1s and your taxes at the end of the year, you can switch out DBC and USO for PDBC and K oil for no K1. Now, over a 3-month back test, you can see that this thing doesn't really do great, but it doesn't do terrible either. But the SPY has been all over the place through this market chop. But the max drawdown is a 1%. So this is what's really great about low standard deviation, is it's going to select whatever is basically not moving at all. Now, this underperforms on its own over a long period of time, but that's what it's designed to do. This is called essentially a hedge or a zero beta, or like a low volatility strategy. You can see that the beta is basically zero. The intent for this type of design isn't to get crazy returns. It's just to build a hedge or somewhere to protect your money. Now, if we do a 3-year back test, actually we can run this. The 3-year back test is not bad. Let me run it back before COVID. So you can see it just kind of, it performs really well during choppy periods. So it basically just kind of ignores the S&P, or ignores the housing market crash. Now, I haven't tested this yet, but I want to see what this would perform as during the 2018 chop. Let's just do, if my computer doesn't freeze. Yeah, so it performs pretty decently over the chop period, just kind of staying flatline. But over the course of like 15 years, especially through the 0% interest rate environments of 2012, basically after the housing market crash, the past decade, it does not perform well at all. Yeah, so it does not perform well at all, but that's the intent. It does actually perform really well during the housing market crash, which is a nice thing, you know, as it should. So that is the low standard deviation. So let's go to the high standard deviation variant, which is this one. And you can see that it's performed really well over the past 3 months. It has done 20% while the S&P 500 has been sideways. If I do a 6 month, it gets a little bit more volatile, 10% drawdown, a little higher beta. If you're not familiar with beta as well, beta is correlation. So a 1 beta means a 1x. Like if you're using the S&P 500, one beta is essentially moving exactly in line with the S&P 500. A 2 beta would be a 2x leveraged ETF. A 3 beta would be a 3x leveraged, and then a inverse ETF like SH, which is a -1 of the S&P 500. A -1 beta would be a -1 leveraged. -2 would be a -2. So if we look back here at this one, which is essentially a 0 beta, it has absolutely no correlation to the S&P 500, which makes sense because there's no logic in here that has anything to do with the S&P 500. We've got oil, commodities, gold, and Forex. So it makes sense that this would be a 0 beta design. Now, this one is a little more higher beta, more correlated to the S&P 500. So let's run this back to before COVID. You can see it drastically underperforms during COVID. And the reason for this, here's the downside of high standard deviation logic. It's indiscriminate towards bullish movement or bearish movement. So if you imagine looking back, well, let's just pull it up here real quick. I will do a standard deviation logic here and turn this to white. Let me make me smaller, and you can see standard deviation. Now, standard deviation unfortunately does not care whether the movement is bullish or bearish. So we have a high standard deviation here on this bullish movement, and we also have a high standard deviation here on this bearish movement. So what I'm getting at is standard deviation does not care whether the market is going up or down. It's just going to measure the throttle at which it is moving. So that's the downside of a high standard deviation. So whenever designing with standard deviation, it's good to have some kind of switch that checks bullishness or bearishness. Now, what I did with this, let's run this back to 2017 or 2007 to the housing market crash, and we will just kind of scrub through here and look at some things. So it does actually. Wow, I didn't even notice that. It does really well during the housing market crash for a second or two. That is probably gold. It's capturing the standard deviation movement of gold. So if we go over to GLD did phenomenal through the housing market crash. Let's just go to the weekly charts. Yeah, you can see it really ran up hard through most of this period. Interesting that it didn't capture all the way to 2012. Actually, did it? No, it stopped out. It didn't capture most of the 2012, probably because standard deviation, but you could design them. So there's a lot of room for improvement here. One of the things you could improve is a momentum strategy of gold. Instead of doing just GLD, you could load a momentum strategy there that might perform well. But you can see over the long term, it does not perform very well. So how do we use these? Well, what I did, if we go back to the main strategy, is I actually loaded both of these into another sort function of 5-day max drawdown bottom one. So what I'm doing here is essentially looking for I'm building a rotation to find what is got the lowest drawdown. So that can be just the low standard deviation. We're essentially rotating between high standard deviation and low standard deviation to capture just the upward movements. So when we want to capture high standard deviation movements upward, but we want to turn them off when the drawdown gets a little too crazy. And then we rotate into the low standard deviation. So we're essentially throttling up, throttling down, throttling up, throttling down by checking the drawdown. Hopefully that makes sense. So if I copy this logic here and just load it in here, my computer is going really slow. I think my memory's getting eaten up right now. Yep, awesome. I don't know if there's some kind of memory leak with Composer, but let me pause this and I'll wait for it to load. Okay. All right, let's run this. And you can see that now we've got a little bit more stability. If I scrub through here, let's start at COVID. So you can see it performs pretty well when we get into the higher interest rates, or higher inflation, higher interest rates. It's a bit choppy, but it does perform pretty well through most of this period as well. And we can see that it is, in fact, pretty bullish through the current bear market. Like, it doesn't seem to care. This is probably in correlation to just inflation kind of slowly. I would see this more as an inflationary movement, while money is being flowed out of stocks and equities and moving into other asset classes. I think that this is just an indication that that money is slowly dripping into commodities and oil and everything else. So let's run this back to 2007. And you can see it also underperforms pretty drastically, and it doesn't perform very well during the housing market crash as well. So the next part of this logic, as my memory crashes, I have 32 gigs of RAM too. This is pretty crazy. Now what we're going to do is check the actual UUP. So UUP, 100-day moving average, and then we're rotating into QQQ. So we're essentially checking to see if UUP is bullish or bearish, and then we're wanting to capture the upside movements of UUP on the daily charts. So I think we're checking the, what was it, the 100-day and then like the 25-day. Is that right? Yeah, 25-day. So simple ribbon, just checking bullishness, bearishness. Let's check out that logic, and I'm going to close these down, delete this. Now we're getting a bit more control, so we're capturing that inflationary movement here on these commodity assets, but we're underperforming during the housing, or during the bull run of the past 10 years. We completely walk over the COVID crash, which is nice, and we don't really perform that great during the housing market crash. So we did isolate and capture the movements here, though, which is kind of what the goal was. Very clean equity curve through this, and it basically doesn't even care about COVID. So that's the isolation there. Now, what I wanted to do was, I asked myself, how can I capture the bull run of the past 10 years, but not using the S&P 500, standard 200-day moving average logic. I wanted to check bonds. So instead I looked at TLT, and I did the 100-day over 400-day, which is a common logic from Derek Nelson, who has built a lot of the FTFL variants. And you can see if we slow down the logic here to 100-day and a 400-day, you can see we capture most of the bull market, but when interest rates rise and inflation rises and bonds get hammered and they start to bear market, we're capturing this. So we're basically turning on, if you just look at straight this logic, when we're in a bear market, we're going into our logic that is separate or zero beta from the S&P 500. So this is designed to capture the inflationary move of this market movement. Of if inflation is rising, commodities typically rise. So we want to capture that with by checking the bond movements. Now, through this period, we are checking the bull market of the housing market crash. So if we run, let me isolate this logic here real quick. And to isolate this logic completely, I'm going to delete this bear market check, and we're going to do just QQQ. So we're just buying QQQ when TLT is bullish. And there we go. This is the really good equity curve. We're capturing most of the movement through the past 10 years during 0% inflation. We do start to capture the COVID, so because we're checking TLT and we're also using very long switches, a 100-day and a 400-day, we are unfortunately grabbing that movement on the COVID crash, so there could be some room for improvement on this logic here. But our max drawdown is still very high, which I don't like. And the reason for that is because we're basically capturing all of the crash through the housing market crash. So the next piece of logic is designed to kind of check this housing market crash. And it's just a super simple logic. If we open up UUP, you can see that UUP actually does really well through the housing market crash. So what I did was I put this bear market check in here. So it looks at the 9-day exponential moving average of QQQ over the 100-day moving average of QQQ. And this is essentially just a market crash check or a bear market check. So when we're bullish on the QQQ, and if we go over to QQQ and turn on these EMAs, let's do the 9-day and the 100-day. You can see that it's going to capture most of the bull markets. There is some periods where it's going to kind of chop, but through the housing market crash, we're definitely checking the bear market. So this logic here is basically capturing all of this movement back to 2007. And as you can see, it does pretty well through the housing market crash. It actually captures most of that UUP movement, and it reduces the drawdown by half, and the annualized return 12.2%. So there's a lot of room for improvement on this strategy. Again, you could mess with the logic through COVID, and you could probably switch around some of these bull market switches to test different things. One of the things I want to see really quick is just capturing gold through that movement as well as UUP. See what that does. Doesn't do a drastic change. It does increase the max drawdown. Annualized returns went up a little bit. You could probably turn this into a rotator or something, or even TLT to capture different things. But yeah, this is just a strategy I wanted to throw together to see if I could beat the current bear market and somehow kind of capture commodities and the inflationary movements moving up here. You guys can do what you want with it. There will be a link to the Discord thread on this. I have yet to post it yet, but there will be a symphony thrown up here. Anybody that wants to do evolutions or mess with this or change things, feel free to, and we can probably design a lot of different strategies around this. Hopefully this will help us build more robust portfolios and perform better during this current bear market. If you're not familiar, Composer has actually just launched dynamic sorting of algos. So here is kind of the idea or the philosophy behind why I just built this strategy. If I take this strategy and copy it, I can actually paste it inside of the dynamic sorting. Now, if I go to my portfolio and I grab one of my best strategies of like the FTFL variants, let's grab BioRect. So if I turn on BioRect here real quick and show you guys, this is BioRect, and it's just been getting kind of annihilated over the past 3 months. If I open it up though, and I copy this, theoretically I should be able to rotate these two strategies based on what's performing the best. Now, let's do bottom standard deviation. See what happens with this. This might not perform well because we're capturing the lowest volatility, but we'll see. Yeah, that's not a good sort function for that. But let's try. Let's do cumulative returns 252. I know this is a good one for just like switching between long-term strategies that are performing well. That one seems to perform pretty well. Let's do a 3-year look back. yeah, so it's capturing a lot of this. I know for a fact that this is the biorect variant, but the logic is still downturning there. But long story short, it's going to take some testing to figure out what is the best way to sort algos. I'm still working on figuring that out. But long story short, we can switch our strategies off and on so that we can capture these movements. Or you could probably just do select top two, see what happens here. Select both of them. And yeah, it slows down the drawdown. But hope you enjoyed this. If you have any questions, DM me on the general chat in the Discord.